Market Whisper presents AI-assisted earnings call summary for company Aptus Value Housing Finance Limited Quarter 3 Fiscal Year 25. Following is the summary of management update provided during the call. Loan book size reached Rupee 10,000 crore mark. Customer base expanded to over 150,000. Branch network strengthened to 300 locations. Net worth stands at Rupee 4,108 crore. Business model is robust with strong distribution network and market penetration. Focused on growth and scalability. Investing in technology, manpower, and expansion. Aiming for loan book of Rupee 25,000 crore by fiscal year 2028. Financial summary reported for quarter 3 fiscal year 25 is as follows. Loan book grew to Rupees 10,000 crore. Number of customers grew to 150,000 plus by end of December 2024. Number of branches grew to 300. Net worth is Rupees 4,108 crore. AUM growth was 27% year-over-year. Disbursement growth was 21% year-over-year. PAT growth was 22% year-over-year. Industry-leading ROA of 7.7% was reported. Best-in-class ROE of 18.54% was reported for the quarter end December 2024. Strong points analyzed by Market Whisper for quarter 3 fiscal year 25 are: loan book exceeded 10,000 crore mark. Customer base surpassed 150,000 mark. Extensive branch network spanning over 300 locations. Robust business model and market penetration. Solid financial performance reflected in high profitability and low NPAs. Investment in infrastructure including new branches, technology, and manpower. Strategic expansion into key markets such as Odisha and Maharashtra. Emphasis on digitalization and data analytics for improved decision-making. Diverse funding sources beyond traditional banking channels. High liquidity position backed by robust balance sheet strength. Positive outlook for future growth driven by strategic initiatives. Some of the key weak points assessed by Market Whisper for quarter 3 fiscal year 25 from the management updates are: loan portfolio is concentrated in specific geographic regions. Limited information about asset quality metrics beyond positive trends. Reliance on external funding sources for expansion. Lack of details regarding technological advancements or their impact on operational efficiency. Potential vulnerability due to concentration risk within key geographical areas. No mention of any regulatory compliance issues or potential risks associated with them. Limited information about competitive landscape and its implications for future performance. Sentiment analysis by Market Whisper. The overall sentiment is positive. Here's why. Strong financial performance. The report highlights significant financial achievements such as crossing 10,000 crore loan books, high asset quality, robust profitability, and impressive return ratios. This indicates healthy financial health and success. Growth trajectory. The company emphasizes its commitment to continued growth, including expansion into new markets, increasing loan book size, and enhancing operational capabilities. These are all positive signs for future prospects. Strategic initiatives. The mention of investments in new technologies, infrastructure, and human capital suggests proactive measures aimed at improving efficiency and competitiveness. Positive customer growth. The increase in live customer count and loan disbursement volume points towards successful acquisition strategies and client satisfaction. We will now start summarizing and provide key takeaways from the question and answer discussion during the call between the various investors and management team of Aptus Value. Question: why are employee costs stable despite significant AUM growth and branch expansion? The questioner wants details about employee headcount, attrition rates, and the breakdown of variable compensation for field officers. Answer: employee costs remain stable due to consistent disbursements. Disbursements remained around Rupee 930 crore. This means there wasn't enough incentive pressure to drive higher costs. Additionally, the company added 100 new employees and saw a 38% rise in collections over the previous quarter. These factors contributed to overall stability. Attrition rates weren't mentioned, but the company expects catch-up with respect to costs in the next quarter. Key takeaway. The company attributes the stability of employee costs to the lack of significant increases in disbursements. Disbursements are around Rupee 930 crore. Employee count has increased by 100 since the previous quarter. Collection volumes have increased by 38 since the previous quarter. Attrition rates haven't been mentioned explicitly, but there is mention of cost catching up, which could imply higher attrition or turnover. The next question was: what percentage of Aptus Value's total borrowing is linked to different interest benchmarks and CLR Abler? Management responded saying, total borrowings are split between fixed 47% and variable 53%. At the variable portion, 30% is linked to MCLR, with 50-16% being tied to 1 year and CLR, 6% to 3 month and CLR, and 6% to 6 month and CLR. Remaining 30% is linked to MCLR and 23% is linked to market rates like Treasury bills or repo rates. Key takeaways. Borrowing structure for company are split between fixed 47% and variable 53%. Variable portion broken down as follows. 30% linked to MCLR 1 year till 15 minutes, 16% directly tied to 1 year MCLR. 23% linked to market rates Treasury bills / repo rates. Remaining 30% is linked to MCLR but with varying terms. MCLR impact. Borrowings impacted by MCLR vary depending on term length. 1 year MCLR till 15 minutes 16% of variable borrowings. 3-month MCLR till 6% of variable borrowings. 6-month MCLR balance of remaining variable borrowings. Question. Investors want to understand the future expansion plans for Aptus Value's branch network in key states like Tamil Nadu TN, Andhra Pradesh AP and Telangana TS. They ask about saturation levels and whether the company sees significant growth opportunities within those markets. Answer. Management clarifies that while they currently operate approximately 88 branches in Tamil Nadu, their focus is on adding new branches strategically rather than aggressively expanding the network. However, they believe the market remains strong and capable of supporting further growth. In addition, they highlight an aggressive expansion plan across other states including Odisha, Maharashtra, and Karnataka. This approach aims to capitalize on the high demand for loans in these regions. Key takeaways. Tamil Nadu, limited growth due to saturation, however, strong market potential exists. New branches planned 6-7 within the current fiscal year. Odisha, Maharashtra, Telangana, and Karnataka, growth focus areas for new branches. Andhra Pradesh, high concentration of branches already present, indicating high market penetration. Loan book growth expected through existing market share. Overall strategy, consistent annual branch openings of 35-40 across all regions. Question. The investor asked about the competitive landscape, competition and opportunities for new state expansion in Maharashtra, Odisha, Karnataka. Specifically, what has been their experience regarding customer behavior, size of the market, and how quickly loans are being dispersed / collected. Answer. Management highlights positive experiences in Maharashtra and Odisha. Loan books are strong, customer acquisition is successful, and repayments are stable. In Maharashtra, the company achieved a significant loan book within a short time frame due to rapid branch expansion. Competition is limited in Odisha, while in Maharashtra some competitors exist, particularly near the neighboring state of Telangana. Overall, the company remains optimistic about further expansion into these states. Key takeaways. Competition, limited in Odisha, moderate in Maharashtra. Opportunity size, good potential for new state expansion Maharashtra, Odisha, Karnataka. Customer behavior, positive strong repayment track record, good customer acquisition. Question. The investor asks why Karnataka's loan book growth hasn't kept pace with Andhra Pradesh and Telangana despite comparable size 3 years ago. Answer. Management clarifies that Karnataka's loan book growth is indeed strong, around 27%. They attribute the slower growth compared to Andhra / Telangana to good promises for future expansion. This includes new branch openings planned for both current and upcoming years. Key takeaways. Karnataka's loan book growth is strong at 27%. Growth in other states is outpacing Karnataka due to higher AUM composition. The company plans to open new branches in Karnataka to drive further growth. Question. What changes were made to the policy regarding write-offs for loans over 24 months DPD days past due? The investors want clarification on whether the company changed its approach to write-offs. Answer. Management clarifies that increased write-offs seen in the current quarter are due to technical write-offs under their accounting policies. These write-offs do not necessarily mean they cannot recover the loan, rather, they reflect the need to adjust the balance sheet based on the actual time elapsed since the initial delinquency. They emphasize that these write-offs are part of the normal process and don't indicate any issues with collection efforts or overall recovery rates. Key takeaways. The company experienced an increased ECL provision credit cost due to technical write-offs for loans over 24 months past due. This resulted in a higher debit in the P&L statement by approximately Rupee 12.5 crore. Despite the increased provisioning, the company continues to see positive developments in its bad debt recovery process. They reported a reduction in net credit cost to 0.32%, indicating improved collection efforts. Question. Is increased work for salespeople and collectors due to planned expansion or simply an increase in headcount? Investor wants clarification about the rationale behind these hires. Answer. Management explains they are hiring to support their ambitious goal of achieving 25%-30% loan book growth over the next 2 to 3 years. They emphasize that the current workforce needs to be prepared for future growth. This preparation includes adding personnel in both sales and collection departments. Key takeaway. Management emphasizes their strategic hiring plan to support anticipated loan book growth 25%-30% over the next 2 to 3 years. Question: investors inquire about the reasons behind the continued low collection efficiency 30-40 bps below historical norms and its potential impact on the upcoming Q4 performance. They specifically ask if specific areas or factors contribute to these lower collection efficiencies and if the expected pullback in Q4 is realistic given current trend. Answer: management explains that while collection efficiency did increase slightly in Q3 from 99.25% to 99.35%, it remains seasonally impacted due to events like Diwali/Pongal celebrations occurring in the same month. The company acknowledges the slight dip in collection efficiency during Q3, attributing it to the influence of seasonal factors such as the Tamil Nadu flood event and holiday season. However, they remain optimistic about an improvement in Q4 with better collection efficiency and reduced Stage 2 NPAs. Key takeaway: the company experienced slight improvements in collection efficiency during the third quarter September/October with an increase to 99.35%. This was driven by factors such as seasonality and positive changes in Stage 2 assets. However, the overall performance remains below historical norms due to continued challenges related to collection efficiency. Question: is the team stability issue resolved in Tamil Nadu, allowing for branch expansion and accelerated growth? The caller expects a positive trend in Tamil Nadu following several quarters of additions but acknowledges past challenges with attrition. Answer: management confirms that corrective actions taken have yielded results, leading them to feel confident about expanding into new locations. They highlight the recent addition of 3-4 branches in the last quarter and plan to add another 2 in the current quarter. For the coming fiscal year, they anticipate opening approximately 6 branches in Tamil Nadu. This indicates an optimistic outlook regarding future growth prospects within the state. Key takeaway: the company believes its internal issues regarding branch stability and attrition in Tamil Nadu have been resolved. This allows them to confidently add new branches and accelerate growth in the state. Growth path: the company expects a return to consistent growth in Tamil Nadu with an anticipated increase in branches over the coming quarters. Question: the investor questioned whether the increase in write-offs was due to an acceleration of technical write-offs or if they were simply following their existing write-off policy. Answer: management clarified that the increased write-offs are solely attributed to assets reaching the 24-month non-performing asset NPA mark according to their established policy. They emphasized that there hasn't been any accelerated technical write-offs. Instead, the higher write-offs reflect the asset age exceeding the standard timeframe. Key takeaways: write-off increase: the write-off amount increased due to assets reaching their 24-month non-performing asset NPA mark. This does not indicate an acceleration of technical write-offs. Recovery focus: management emphasizes the positive aspect of the write-off increase by highlighting the significant recovery achieved during the quarter. Bad debt recovery reached Rupee 5 crore, significantly higher than Rupee 1 crore in the previous quarter. Question: is the decrease in operating expenses OPEX sustainable long-term, given it was driven by factors like salary costs being relatively low due to flat disbursement? Will the OPEX ratio settle at lower levels or is it a temporary blip? Answer: the company maintained its target OPEX to asset ratio at 2.7%. This reduction in OPEX is not expected to be sustained indefinitely. There may be some increases in salary costs in future quarters. However, they are confident their OPEX to asset ratio remains competitive and better than competitors. Key takeaway: the company expects its operating expense OPEX to asset ratio to remain stable at approximately 2.7%. This was previously guided by the company. Question: investors want clarity on future credit costs after seeing an increase due to write-off recoveries being classified under other income. They seek confirmation that this trend won't persist indefinitely. Answer: management confirms their previous guidance of 0.35%-0.4% for credit costs moving forward. This implies no significant change in expectations regarding future credit losses. Key takeaway: management expects credit costs to remain at around 0.35%-0.4%. Question: investors want to know about the potential impact of insurance product distribution on future revenue, specifically how much could it add to our other income on a monthly or quarterly basis? Answer: management acknowledges that they recently obtained a corporate agency license but emphasizes that discussions with insurance companies for partnerships are ongoing. They plan to provide more information when these final agreements are reached. Key takeaways: management expects significant contribution from insurance product distribution but doesn't give specific numbers yet. The company has secured its corporate agency license for insurance distribution. Negotiations with 2 ministry insurance companies are ongoing. Finalization of these negotiations will determine the timing and magnitude of future contributions. Question: investors want information about the percentage of Aptus Value's loan book tied to the Pradhan Mantri Awas Yojana PMAY scheme and the performance trends within the sub-Rupee 10 lakh segment. Answer: management acknowledges challenges related to PMAY implementation due to ongoing software stabilization efforts by the government. They expect clearer insights into its impact on their business during the following quarter. Regarding the sub-rupee 10 lakh segment, they highlight an average ticket size of rupee 8.5 rupee 9 lakh across various product offerings. Collection efficiency remains strong at 99.35% while bounce rates are low. Overall, the portfolio exhibits positive performance. Key takeaways. PMA management expects clarity on its impact within the next quarter due to ongoing delays in government software implementation. Sub-10 lakh category average ticket prices fall within this range 8.59 lakhs, showing strong performance despite being below the threshold. Collection efficiency high efficiency levels around 99.35% indicate minimal delinquencies or defaults. Bounce ratio low bounce ratio suggests low default rates and overall healthy loan portfolio. Question: what is the expected growth rate for the fiscal year 26 book loan book? Answer: the company expects disbursement growth of 25% minus 27%, with a loan book growth of 30%. They are confident in achieving these figures. Key takeaways. Management expects continued strong disbursement growth around 25% minus 27% in fiscal year 26. Loan book growth is expected at 30%. Question: the investor wants information about the current penetration rates of credit life insurance offered by Aptus Value and its potential growth with an existing customer base. They also want details regarding the overall insurance penetration across all products offered by Aptus Value. Answer: Aptus Value has secured a corporate agency license allowing them to offer credit life and property insurance directly to customers. Currently, they offer optional credit life insurance with a conversion rate of 80%. This means approximately 80% of customers choose to purchase the product when presented with an opportunity. With a new corporate agency license, Aptus Value plans to expand offerings beyond credit life into other areas like property insurance. Key takeaways. Credit life penetration. The current penetration rate for credit life insurance among customers is estimated at 80%. This suggests a significant opportunity for growth within existing customer bases. Insurance potential. Management believes that the new corporate agency license opens doors for increased sales opportunities across various insurance products like credit life, property insurance, etc., leading to higher revenue generation. Customer opt-in. Credit life insurance is offered as an optional add-on service by Aptus Value rather than being mandatory. Customers choose to opt in after understanding its value proposition: loan protection. Question: will Aptus Value be offering health insurance products alongside its existing offerings housing loans? Answer: no, Aptus Value does not intend to offer any other products besides life insurance. Key takeaway. Management confirms that they would not offer any other product other than life insurance and co-selling insurance products alongside housing loans, which is their mainstay. Question: investors want to know how confident they are about achieving a 7% ROA by fiscal year 28 financial year 2028 when aiming for 25,000 core AUM. They also inquire about expected ROE within that time frame. Answer: management states that reaching 25,000 core AUM would necessitate higher leverage due to existing capital adequacy ratios and limited need for equity raises. This implies lower ROA than their current target of 7%. The projected 7.7% ROA may drop to 6.5%, while the 18.54% ROE could potentially exceed 22%. Key takeaway. Management believes achieving 7% ROA by fiscal year 28 is unlikely due to increased leverage associated with reaching a target AUM of 25,000 crores. The company expects a lower ROA, likely between 6.5% when they hit their targeted AUM level. Despite the potential decrease in ROA, the company remains optimistic about its long-term growth trajectory, aiming for an even higher ROE than the current 18.54%. Question: is the higher growth in the SBL segment expected to continue, and what changes have been made to the SBL business? Answer: management states that the current product mix: home loans 61%, quasi-home loans 14%, small business loans 21% reflects no significant change compared to previous periods. They emphasize that while some quarters may see fluctuations due to seasonal factors, the overall mix will remain consistent with these proportions for the foreseeable future. Key takeaways. Management expects the current product mix: home loans 61%, quasi-home loans 14%, small business loans 21% to remain stable. The company sees an increase in housing loan proportion over time, currently at 72% compared to earlier 70%. Question: what kind of commissions are being received for insurance policies sold through Aptus Value? Answer: the company will discuss this further at a later date. Explanation. The investor asks about the specific commission structure used by Aptus Value when selling insurance products. They want to understand how much revenue they generate per policy sale. Management responds vaguely, stating they will address the topic later. This suggests there may not be an immediate breakdown or explanation available during the current quarter's earnings call. It also implies that details might be more complex than simply disclosing a single percentage figure. Key takeaways. Management did not disclose specific details regarding commissions earned on insurance policies sold by Aptus Value. Management indicated they would discuss this further with investors at a future date. Question: the investor wants to know the average asset under management AUM per branch for 5 years plus vintage branches. They are specifically interested in this data over a longer time frame than just 3 years. Answer: management confirms that the average AUM per branch for 5 years plus vintage branches is approximately ₹65 crore or more. Key takeaways: AUM per branch for 5 years plus vintage branches is estimated at approximately 65 crore or more. Question: investors want to understand the specific incremental rate increase on home loans during Q3 and predict future trends and funding costs for Q4 fiscal year 25 and potentially Q1 of the following fiscal year. They also inquire about maintaining current spread levels over the next 2 quarters. Answer: management clarifies that no changes were made to existing home loan rates, keeping them within the range of 14.5% minus 15.5%. Cost of funds remains stable for both Housing Finance Company (HFC) and Non-Banking Financial Company (NBFC), with HFC costing around 8.5 minus 8.7% and NBFC slightly increasing to 9.1%. Future trends depend on potential rate cuts but could lead to increased spreads. However, without those cuts, an additional 0.1% decrease in net interest margin might occur due to higher interest rates. Key takeaways: incremental home loan rate remains unchanged at 14.5% minus 15.5%. Cost of funds Housing Finance stable at 8.5% minus 8.7%. NBFC cost of funds slightly increased from 9% to 9.1%. This increase is expected to persist through Q4. Potential spread changes, dependent on future rate movements, could benefit from potential rate cuts but could also face pressure due to rising costs. Question: will the yield decrease due to increased competition in Maharashtra and potentially other states? The investors worry about potential downward pressure on yields and spreads. Answer: management believes that they won't see a significant drop in yields or spreads despite entering new markets like Maharashtra with higher competition. They cite past experience in Telangana and Andhra Pradesh where similar competitive environments did not lead to lower yields. Key takeaways: competition. The question highlights concerns about potential yield compression due to increased competition in states like Maharashtra. Yield impact. Investors seek clarity on whether a decrease in yields could occur with growing competition. Management response. Management confidently asserts that they won't see any significant impact on yields despite increasing competition. They cite past experience in other markets Telangana/Andhra where similar competitive environments didn't lead to yield reductions. Question: how many branches are scheduled for opening in Maharashtra during the fiscal year 2024-25? Answer: management plans to open another 10 branches in Maharashtra and Orissa over the coming year. Key takeaway: management plans to open another 10 branches in Maharashtra and Orissa over the next year. Question: is there still juice left in the southern states Telangana and Andhra Pradesh after their rapid growth over the past year? Will future growth be similar to previous performance? Answer: the company hasn't even tapped into the full potential of the market yet. There's significant room for expansion in both existing and new states. Future growth will be driven by new branches opening in new states, existing branches seeing higher productivity due to additional personnel, increased average ticket size ATS, maintaining healthy loan-to-value ratios LTV while increasing asset under management AUM. Key takeaways: market opportunity. The company sees significant potential for continued growth in its southern state operations Telangana and Andhra Pradesh. They believe their penetration into the market is currently low. Growth drivers. Growth will be driven by expansion into new markets, new branches/states, internal improvements within existing branches, increased efficiency through staffing optimization and higher file processing rates, and an increase in average ticket size ATS with no impact on loan affordability. AUM guidance. The company expects a 30% annualized average asset under management AUM growth over the next 3 to 4 years. Question: the investor wants to understand how regulators, NHB and RBI view Aptus Value spreads considering concerns about high lending rates by certain NBFC under the previous regime. Answer: both NHB and RBI conducted inspections during fiscal year 24 and did not raise any queries regarding Aptus Value's interest rate charges. An interim comparison with other NBFC and HFCs showed Aptus Value's rates were within acceptable ranges. There haven't been any regulatory requests to reduce interest rates charged by Aptus Value. Key takeaways: the question focuses on regulatory scrutiny regarding the interest rate structure of Aptus Value compared to other NBFC and HFCs. Management highlights 2 key points. No queries were raised during the recent inspections fiscal year 24 by NHB and RBI concerning their interest rates. An internal comparison with other NBFC and HFC shows Aptus Value charges comparable or lower rates. There haven't been any requests from regulators to reduce these rates. Question: the investor wants to understand whether Aptus Value plans to maintain its current product mix with mostly floating rates with a larger loan portfolio, especially considering potential future changes in interest rates. They also inquire about how the company intends to manage the liability side of their balance sheet given the increased size. Answer: management states that despite a large loan portfolio expansion, the leverage remains relatively low, around 3-4x. This allows them to effectively handle interest rate risks associated with variable rates. Additionally, while offering fixed-rate options due to customer demand for stability, the company believes leveraging provides an effective solution for managing these fixed-rate obligations. Key takeaways: concerns about potential changes in product mix due to increased loan portfolio size from Rupee 25 crore with higher proportion of fixed-rate loans impacting liability side of the balance sheet. Management answer focuses on low leverage 3-4x, which mitigates interest rate risk despite offering variable rates for customers who prefer them. Emphasizes that fixed-rate lending is driven by customer demand for stable ME/tenors. Question: investors want to understand how much growth they can expect from individual regulated entities within Aptus Value's portfolio as well as their overall performance over the next few years, specifically mentioning the regulatory environment. Answer: management states that while the company has set an overall target of 30% annualized asset under management AUM growth over the next 3 to 4 years, the specific growth rates for individual regulated entities will vary due to factors such as the size of the loan books and the composition of products offered. They emphasize that comparing growth rates solely on the basis of loan book expansion alone isn't appropriate because the focus should be on the overall AUM growth strategy and the projected 30% average annual growth across all assets managed. Key takeaway: management expects continued growth in their portfolio across all regulated entities. The growth will be driven by both product mix changes and an overall target of 30% annualized asset under management AUM growth over the next 3 to 4 years. Question: the investor questions whether Aptus Value needs its current step-down subsidiary NBFC given they manage the 60% ratio on a consolidated basis already. Answer: management states flexibility is key but emphasizes the benefits of maintaining the NBFC due to product diversification and income stream diversification. Clear demarcation between HFC and NBFC books ensuring no customer overlap. Separate structures for NBFC including business heads, credits, and branches. Addressing the limitation imposed by the 60% asset criterion on their overall lending capacity. Opportunity to access the large market for small business loans without such restrictions. Key takeaway: the company needs a step-down subsidiary NBFC due to regulatory requirements and its potential benefits such as increased flexibility and access to new markets. Question: what is the expected end loss LGD from the written-off pool? Also, what is the BT out rate? Answer: the expected end loss from the written-off pool is minimal due to low LTV loan-to-value of 40-45% with no or very small principal write-offs. This is because the borrowers are responsible and live in the properties they financed. They can repay the loans as per agreements. The overall BT out rate is approximately 2.5%. Explanation: the key takeaway here is that Aptus Value has a strong focus on managing its assets effectively. Their portfolio includes primarily secured loans backed by real estate, like home mortgages. As such, they experience relatively low defaults and therefore minimize potential losses. Key takeaways: asset quality: the expected loss given default LGD is extremely low due to the relatively high loan-to-value LTV ratio of 40-45% with no or minimal principal write-offs anticipated. This is attributed to the fact that borrowers are primarily homeowners who actively reside in the property securing the loans. Recovery through foreclosure is unlikely as the borrower remains responsible for repayment. BT out rate: the bank transfer out BT out rate stands at approximately 2.5%. This reflects a significant portion of pre-closure activity driven by large cash flow patterns among borrowers. These individuals prioritize settling their housing loans before other financial obligations. Question: what happens if there is a rate cut specifically regarding their business model? Will they see an increase in BT out rates due to Aptus majorly as of now being a fixed-rate lender? Answer: they won't write off any principal or interest. Instead, they will waive certain charges during loan settlement processes. This results in no change in the IRR compared to the contracted rate, only a delay in payments. Key takeaways: rate cuts could lead to increased BT out rates for lenders like Aptus. However, Aptus won't write off principal or interest. Instead, they will waive certain charges during loan settlements. As a result, the IRR remains consistent with the original contract rate despite potential delays in payments. Question: investors want clarification on whether Aptus Value's BT out rate will rise as interest rates potentially fall during a rate cut cycle. Answer: management states they have operated through various rate cycles with consistent BT out rate at 2.5%. They believe any potential increase due to lower rates will require them to do more business. Key takeaways: Management believes they can continue with current BT out rate around 2.5% even during potential future rate cuts. They expect increased demand for loans due to lower interest rates, but acknowledge that high borrowing costs could lead to further increases in BT out rates. The focus is on managing the impact of rate changes while maintaining consistent BT out rate. Question: investors are curious about the differences in yields for Aptus home loan and non-housing loan businesses. Specifically, they want to know the average interest rates charged by each segment. Answer: management clarifies that there are three product types offered: housing loans 14.5%, 15.5%, quasi-home loans 17%, 18%, and small business loans 20%, 21%. Key takeaways. Management provides a breakdown of their lending product offerings. Housing loans are offered at rates ranging from 14.5% to 15.5%. Quasi-home loans offer rates between 17% and 18%. Small business loans carry rates between 20% and 21%. Question: why aren't they expanding geographically faster given their capital position? They specifically mention that they have invested significant time in Maharashtra 3 years and want to see more growth. Answer: management explains that while they have recently opened a branch in Maharashtra after being present for just 9–10 months, they expect continued success in this market. However, they emphasize that expansion will be gradual and measured, with no plans for rapid or sudden increases in branches. Key takeaways. Management acknowledges that they have significant capital available for geographic expansion. They highlight their recent entry into Maharashtra with a single branch opened in March 2023. Despite this limited presence, they express confidence in Maharashtra's potential and plan to expand further. Expansion plans are expected to be gradual and measured rather than rapid or aggressive. Question: the company faced issues with e-Khata implementation in Karnataka as seen by other companies. Did they experience similar problems in their operations? Answer: yes, they experienced the e-Khata issue but were less impacted than others due to being located outside major cities. They explained that delays in disbursements occur when using e-Khata due to its slow processing and advised customers to apply for e-Khata beforehand. Key takeaways. E-Khata delays impacting disbursements. The company has experienced delays in disbursements due to issues with the e-Khata system in Karnataka. Impact limited to peripheral areas. Disbursement are less impacted in rural or peripherally located areas compared to urban centers. Customer advised to pre-plan. Customers are encouraged to obtain their e-Khata before applying for loans to avoid potential delays. RTGS disbursement remains unaffected. Despite the e-Khata challenges, the company continues to offer immediate RTGS disbursement upon loan approval. Question: what is the company's login to sanction ratio percentage and how long does it take for a file to go from login to sanction to disbursement? Answer: the login to sanction ratio is approximately 85%. This means 85 out of every 100 files get sanctioned. It typically takes between 1 minute to 2 days for a file to move from login to sanction. Disbursement usually takes 7 to 8 days after sanction due to the need for legal document verification. Key takeaways. Login to sanction, around 95% sanctions are logged within 1 to 2 business days. Sanction to disbursement, approximately 80 to 85% of loans get disbursed within 7 to 8 business days due to document verification process. That's all folks for now on Aptus Value. If you did like the content, please do like, subscribe and or comment on the video. Thank you for your time.